Okay, so next question we have here is, this is the next question in front of you. If overheads contains a fixed cost and management set prices by making up a product cost, means cost of the product, by preset percentage, some percentage, preset percentage, then what will happen to the selling prices? If lower unit sale volume is expected. What is the right answer? A, B, or C? Let me know. What is the right answer? A, B, or C? I'm giving you 1 minute. Think over it and let me know what you think. So unit sale volume, unit sale volume. So now the volume, if it is expected less, if lower sale volume is expected, what will happen to the selling price, sale price? So sale price is a cost plus profit is equal to sale price. If there is a percentage is set, and even then if the lower cost, like lower unit sale volume, quantity is expecting that we are expecting less quantity, and definitely the selling price will also increase, likely to increase, because if the low unit low quantity is produced, higher will be the cost price, and higher will be the cost price, then percentage on that, fixed percentage on that, definitely the sale price will be higher, right? So in this case, the answer will be A. Answer will be A. Now, next question is, in case if selling prices increase, selling price like from 100 to 120, for example, like what will happen to the unit sales volume? Unit sale volume will likely increase, unaffected, or decrease. Okay, take your time. Write your answer. Okay, so look at the answer now. Yes, so answer is unit sales volume will likely decrease. So sale volume will likely decrease, right? If the selling price increases. Okay, so now next we can see that cost flow, material purchase, right? So material purchase, raw material purchase are recorded in an inventory account, right? So raw material is purchased. So once the raw material is purchased, what will be the journal entry for this? So raw material is what? So all expenses are debit all the expenses, right? So raw material account debit is $60,000 and account payable. And we assume that we have purchased this raw material on credit basis. So if we have purchased this on the credit basis, and this is the liability, account payable is the liability, $60,000 that we will put it here, right? So this will be the journal entry for when raw material purchases are recorded. Okay, so in this case, what happened? Material used may be either direct or indirect, right? So material used may be either direct material or maybe use indirect material. Okay, so we have here material acquisition means material purchase. Then definitely job sheets to that we will prepare. So direct material means if there is a direct material, then job cost sheet will be prepared, right? Second, manufacturing overhead cost. That is the indirect material means you can say that indirect material will be maybe related to the product which is not directly, which cannot be determined easily, right? Which cannot be traceable, indirect material. Okay, so direct material, indirect material. Look at this. Direct material issued to a particular job increase. Direct material issued to a job increase work in progress and decrease raw material. Yes, definitely it happens because when direct material will be issued to a particular job, then what will happen? Then raw material is decreased and work in progress increase, because from the raw material there is a big warehouse. From the warehouse the raw material has been taken. From the raw material, maybe wood has taken, the wood has taken from the big warehouse, and in the manufacturing unit the wood is placed. So the one is decreased and another stock is increased. So from the raw material, from the warehouse, raw material is decreased and work in progress is increased. It means work in progress account debit to raw material. So indirect material used are charged to manufacturing overhead. So if there is a direct or indirect, there are two things. Direct is work in progress. Direct will be work in progress, and indirect will be manufacturing overhead. So if there is indirect material used, means manufacturing overhead account debit to raw material. So let's see. So work in progress account debit, manufacturing overhead account debit to raw material. So we have two debits and one credit here. It means this is the total raw material that we have $52,000. Look at this in the job order sheet cost flow material, how the cost is flowing, right? So raw material that we have 52,000, right? So raw material that we have 52,000, and that 52,000 means like you can say here we have one, we have two, and we have three. The first we can say direct material, job one. Let's say for the job two, direct material is 22,000, and for the manufacturing overhead that is 2,000, and like 28,000 plus 22,000 is equal to 50,000 here. So 50,000 number two, right? So 50,000 plus 2,000. So 50,000 is you can say direct material. So direct material, it has been taken from the warehouse and put in the production factory where there were two jobs. Maybe this one is for the dining table, this one is for the chairs, for example. So that wood, for example, is used for $28,000. 28,000 costing of that wood is used for making a product A, and 22,000 for product B. And on the other side, we have indirect, like indirect material means a manufacturing overhead. Manufacturing overhead that is used 2,000. So in this way that we have created 1, 2, and 3. And there was some opening balance. This was opening balance here and opening balance here, right? That was the opening balance. And this is a $60,000. What is that? Go back. I can show you. $60,000 is this one. Raw material was purchased. So when raw material were purchased, so look at this. There was the raw material account, and 7,000 was opening balance, at 60,000 was purchased, and 52,000 that was issued. 52,000 issued to the work in progress department, right? In the production department where two product was in progress. Okay. Now in this way that we prepare account. Look at this. Now job ordering cost document flow for the labor. Now we have calculated for the direct material. So now direct labor is also there. So direct labors and employees time may be either direct or indirect. Yes, the time may be direct or maybe indirect. Direct may be directed to the product, right? Or indirect, that it is difficult to calculate. Okay, now employee time tracking system for the direct labor will be from the job cost sheet, right? And indirect will be from the manufacturing overhead account. Manufacturing overhead account, that is employee time ticket. Now labor, the cost of the direct labor incurred, that will increase. Yes, definitely will increase the work in progress. In the work in progress, the direct labor cost will increase, and the cost of indirect labor increase the manufacturing overhead. So work in progress and manufacturing overhead, both are the expenditures. Both are the expenditures for the labor will increase. Look at this. Work in progress for 60,000. Work in progress 60,000. That is the first part. And the second is a manufacturing overhead. That is indirect labor. This is, we are talking about the labor. And salary and wages payable $75,000. So work in progress is expenditure. Manufacturing overhead is expenditure, direct and indirect. Go next. Salary and wages payable $75,000. And from the $75,000, if we say that there are direct labor for this job A, direct labor 20,000 for job B, and if we charge $15,000 is indirect labor that we are not able to calculate, we are not able to find out directly. So that is indirect labor in the manufacturing overhead, in the production factory, in the manufacturing unit. So $60,000, we definitely will write here work in progress. So work in progress is $60,000, that will be here debit, and this is debit and this is credit. So two items on the debit side, like 60,000 plus 15,000, and one item on the credit side. Look at the back again, two items on the debit and one is on the debit. So debit that we have written here on the debit side, and credit is on the credit side. Definitely, this is the simple rule. Debit put on the debit, credit put on the credit. From the general entry, debit put on the debit, and credit put on the credit side. 70,000 credit side in the respective account, like in the respective account. This is the rule. I'm repeating once again. Look at this. Work in progress is 60,000 debit. Go to the work in progress account, write 60,000. Go to the work in progress, write 60,000. Okay. Now go to manufacturing overhead, write 15,000 on the debit side, right? And go to the salary and wages payable account and write 75,000 on the credit side. That we did. Okay, so this is related to the labor. Now next we have here the overhead incurred, manufacturing overhead account. That indirect labor we have, that employee time ticket. Now other actual overhead charges. If there are some actual overhead charges that will be calculated here, right? So material acquisition, indirect material, indirect labor. So indirect material, indirect labor, that will be calculated. And if there are other actual overhead charges, that also will be calculated here in the manufacturing overhead account. Now look at this. In addition to indirect material and indirect labor, other manufacturing overhead costs are charged to the manufacturing overhead. As they are incurred. Look at this. Now manufacturing overhead is, let's say, $78,000. So manufacturing overhead, 78,000. Account payable, 40,000. Property tax payable, 13,000. Prepaid insurance, 7,000, and cumulative depreciation, 18,000. So these are the manufacturing overhead expenditures, right? Previously, look at this previous journal entry. So that was the work in progress. That was related to the labor, material, labor, and other manufacturing overhead. So this is other manufacturing overhead. We are talking about the other manufacturing overheads cost. So this is other manufacturing overhead cost apart from the direct material or direct labor. So that will be 78,000, but it is divided into 1, 2, 3, 4 type of expenditures, which is here is calculated. So manufacturing overhead account will be applied to the overheads in the job cost sheet. Look at this. Work in progress is increased when manufacturing overhead is applied to the job. Assuming that pre-overhead rate is a 6 per machine per hour. Machine hours used by A and used by B job is 10,000 and 5,000. There are two kind of machines are there. Two kind of machines are there, 10,000 and 5,000 hours that used. Okay, so so work in progress definitely that will increase when the manufacturing overhead is applied to the job. Look at this. Work in progress 10,000 plus 5,000. So 10,000 plus 5,000. Total number of hour is what? So total number of hours are 15,000. 15,000 into 6 is equal to 90,000. So 6 is per machine hour. If we calculate, so if you have a calculator, then you can see that if we divide 90,000 is a manufacturing overhead, 90,000 divided by number of hours, that will be predetermined overhead rate. That is 6 per machine hours. 6 per machine hours. So work in progress account debit to manufacturing overhead. Next, look at this. So here we can see that overhead applied to work in progress that will be 15,000 into 6 90,000, and here the 90,000 is here the work in progress on the debit amount on the debit side, credit amount on the credit side. Now, so this 90,000 is divided into two jobs. The first job is $60,000 and second job here is the $30,000. So how we have calculated the 60,000 and 40,000? It all depends on the number of hours. If 15,000 machine hours are there, so 10,000 hours that we used here, so 10,000 into 6. 10,000 into 6 is a 60, then 5,000 into 6, 15,000. And the rest of the remaining 5,000 into 6 is 30,000. So 30,000 here, 30 plus 60 is equal to 90. That is expenditure and applied to the jobs, both jobs. Next. So now cost flow, cost of goods manufactured is calculated. The same thing, right? We know that how we calculate for the job A. So look at this. Assume that a job A is considered completed and the total cost assigned to a job A is 158,000 to complete 1000 units. So it means 1058 divided by 1000 is equal to 158 per unit. This is the cost per unit that we have. So here what we have seen here, 30,000 direct material, direct labor, and manufacturing overhead. So 158. So $158,000 cost that will now shift to the finished goods. Finished goods to work in progress. Step by step, we are progressing. So as the job are completed, cost of goods manufactured is transferred to the finished goods from work in progress, right? From the work in progress, that material cost will decrease, and finished goods cost that will increase by this amount. Now assume the further 750 units are sold for 225 on account, right? So 750 units were sold. So if the 750 units are sold and the selling price is 225, it means a debtors account debit means account receivable account debit to sale. Sale is always credit, right? And on the other side, if there is a cost price, so we know that if there is a cost price anywhere, then the cost price will be written here like this. So let's say the cost of goods sold is this much. If the cost of goods sold is this, so what is the cost of goods sold account debit to finished goods? So finished goods is credited because finished goods has decreased and cost of goods sold has increased. These are the expenditures. So the debit all expenses and losses. So debit all expenses and losses here, right? Now let's see next page. Now look at this. If we talk about here a general model of cost flow, you can see at the top raw material, then salary and wages payable and manufacturing overhead. And from the raw material, you can see that from the raw material, some of the material here is just coming from here to here, debit to the actual overhead cost incurred. And selling and wages payable, then that will be coming over here also in the manufacturing overhead. Now, if we see that a work in progress, finished goods, and a cost of goods sold, then automatically that we are calculating raw material and all these expenditures, and that will be coming for the work in progress, finished goods, and the last cost of goods sold. So whatever that we have done previously, all the entries, so those entries are debited and credited accordingly. Now look at this. Next page is saying that now sometime what happened, there will be a under or over applied overhead. Under applied or over applied. What is the meaning of this? It means at the end of the period, if we make a total of all the expenditure, then we will come to know what is the total expenditure, means what is the total cost. If you say that if the total cost is like $95,000, if this is a manufacturing overhead, we are talking about the manufacturing overhead. So manufacturing overhead like 2,000, then 15,000, then 40,000 and 20,000. It means direct material and direct labor, that we are not talking about that. We are talking about the manufacturing overhead, right? So manufacturing overhead means indirect indirect expenditures. So that we have added here. We know that 90,000 that we estimated, but actually what happened? Actually 95,000 that was a total cost. So 5,000 that was under applied. So we definitely will add it. It's under applied. What is the cause of like under or over applied overhead? That is estimated and actual price of the individual overhead items are different. That's why the estimated and actual amount of the allocation base are different. The allocation base used for apply overhead may not be representative of the various factors that potentially drive the different overhead cost item. The rate computed and used effectively treat overhead as a variable cost, whereas many individual overhead item may be fixed in nature. Sometimes what happen, we think like there may be some of the cost are fixed, some of the cost are variable, and some of the costs are fixed in nature, right? There is a possibility only because of these variables. Some are fixed, some are variable. So there may be some uh, variation in the actual and budgeted. So this is the cause. Now, if there is over applied or under applied, if this is under applied in this case, right, then applied overhead is less than actual, means under applied. Applied overhead is more than that, means over applied. So if this is under applied, we will increase the cost of goods, and otherwise we will decrease the cost of goods, right? Let's say over applied and under applied manufacturing overhead uh, disposition options. For example, like $5,000 may be allocated to these account. So now if the 5,000 is here under applied, and that will be distributed among three: work in progress, finished goods, and cost of goods sold. And 5,000 may be closed or closed directly to the cost of goods sold. There are two ways. The one is that 5,000 we are going to calculate someone here, someone here, someone here. Or what we can do, if there is a cost of goods sold at the end, that we will definitely will add in there. That's it. This option is also good, right? Right. So we know this is the cost of goods sold actually, and we will add this $5,000. That's it. It means that we are going to apply. So allocated across cost of goods sold and other inventory account. Now cost of goods sold is let's say 2469, right? This is the cost of goods sold if we're going to divide in this way, right? Finished goods 1031 and work in progress is 1500. Proportionately that we have divided. Manufacturing overhead is this $5,000. So the cost, one cost, two costs, and three costs, all expenses are debit. So we have increased, we have applied that under applied cost. We have applied here. Now the this one was allocation or allotted across cost of goods sold and other inventory account. These are the inventory count, like work in progress, finished goods, cost of inventory count. But in this case, if this is going to be like the cost of goods sold, it means we are going to apply directly to the cost of goods and to the manufacturing overhead. Both methods are right. Now, renovation, once actual overhead for the year was $6,000 for the total 27,000 direct labors. Now, how much total overhead was applied to the renovation cost job during the year? Okay, so this is what we are going to see. Let's say if we calculate $600,000 and divide by 27,000, that will be 22.22. So if you talk about uh, POHR, that will be less as compared to the budgeted, right? So this is the one. Now, how much total overhead was applied to the renovation one's job during the year? So use a renovation one's predetermined overhead rate of this much. So this is the predetermined and this is the actual one. So actual is less than, predetermined is more, right? Now look at this. Okay, so now what you need to think. In this case, what I'm going to do, I'm just going to show you the solution of this. The solutions of this will be here in front of you. This is the solution. POHR, predetermined overhead rate. We know that predetermined overhead rate is already here. Predetermined overhead rate is already here. This is the predetermined overhead rate. And second is we know that number of hours as that we started at the beginning, 27,000 is a direct labor hours. So 27,000 into 22.50, this is the 607,500 is applied overhead. So now we have here applied overheads, right? So this is applied overhead, but actual overhead is a 600,000. Actual overhead is 600,000. So there is a difference between these two is a 7,500. Look at this. So renovation one has over applied. So in this case, this is 600 is the actual, but we applied this one. So we have applied this one. I mean, 7,500 is over applied. So what will renovation one do? So what will renovation one do? So definitely, if it is over applied, we will do some adjustments. Look at this. So this is a renovation one cost of goods sold, unadjusted balance. Then what we will do, actual overhead is 600,000. Overhead applied is 607,500, and 6,700 is over applied, and over applied will be here. We will write on the credit side. That is the main balance over here, right? So this is over applied amount will be deducted from the cost of goods sold. We thought that this is the cost, but actually this is not the cost. We applied this one, but we applied more, like 7,500 more, that will be deducted from here, right? This is the main case. Okay, so we have one question. What effect will be the over applied overhead have on renovation one's cost of goods sold? So here the question is, what effect will the over applied overhead have on renovation one's cost of goods sold? What is the effect that will be over applied cost? If we have over applied, Now, so what we are going to do, we are going to reduce it. When we are going to reduce this, mean expenses have reduced. If expenses has reduced, mean cost of goods sold, cost of goods sold will reduce. But in this case, what happened? What effect will the over applied overhead? So in over applied, it means already over applied 607500 means 7500 is the already that applied here. We applied that one, right? Which was we budgeted. So in this case, what will happen? If we're going to reduce it, if we are going to make subtraction, make some adjustment from 607500 minus 7500, then cost of goods sold will definitely decrease. Cost of goods sold will decrease, right? So this is the answer. Next question is, what effect will the over applied overhead have on the renovation one's net income, means net profit? So what is the right answer according to you? Definitely, if the cost is decreased, net profit will increase. If we have over applied, so over applied that we are going to adjust, make some adjustment, right? So over applied will definitely will have, if it decrease it, cost will go down. If the cost will go down, the net profit will definitely increase. So net profit will increase. So next question. This is the Tiger Incorporation had actual manufacturing overhead cost is 1210000 and predetermined overhead rate is 4 and per machine hour. So Tiger Incorporation worked at 290,000 machine hours, right? In this case, machine hours. In the previous example, that was a number of our labor hours. So Tiger manufacturing overhead is 50,000 over applied, under applied, over applied, or under applied, like 50, 50, 60, and 60. What is the right answer according to you? What is the right answer according to you? Let me know what is the right answer according to you. So actual manufacturing overhead is 1,210,000. 1,210,000. This is the total cost. And predetermined overhead rate is 4. So in this case, the answer would be $50,000 that will be over applied. $50,000 $50,000 is under applied. under applied, because we can see that 290,000 multiplied by 4, that will be 116000, means 1.16 million. But actually what happened? Actually the cost is 12100. The difference between two is the 50,000. So 50,000, that was not applied, because actual manufacturing overhead will be calculated at the end of the period, end of the day, end of the quarter, end of a 6 month, end of the year, right? When they calculated what is the real expenditure, but expenditure, that is the 1.21 million, right? But applied was less. If less applied, it means how much is the less applied? It means under applied, not over, it's under applied. So under applied is the 50,000. Definitely we will add in the cost, and definitely we will add in the cost. So look at this, you can find this answer. Now, so multiple predetermined overheads in the preceding examples, there remains a balance in the manufacturing overheads, and so far we have assumed that there is a single predetermined overhead rate for the whole company, and this is called a plant-wise overhead rate. If the one rate is there, it's a plant-wise overhead rate. In big company, there may be sometime multiple predetermined overhead rates are often used. For each department will different rate usually have their own overhead rates, considered to be more accurate compared to the plant-wise overhead rate, right? So overhead is applied in each department according to their own overhead rates as the job proceed throughout the department. So we have learned today, job costing is used for a unique job, whereas the process costing is used for the mass production for similar goods. Process costing is for the similar goods. This is unsimilar goods, job costing. So today we have done job costing. So job cost include direct material, direct labor, and overheads. Individual job costs are tracked on the job cost sheet, and the cost of goods sold manufacturer captures the cost for all jobs worked on the during the period. Overhead is applied to job during either normal, means predetermined rate, and actual. So normal mean budgeted or predetermined. The difference between the actual and applied job must be write-off, mean adjusted at the end of the period, to ensure that a financial statement include accurate information. So this was all about the job costing today that we completed.